With us is David Wessel, Senior Fellow in Economic Studies at Brookings. Great to see you again.
Good to be with you, Kelly.
And we mentioned it off the top, but I think we should drill down on it once again. Right now, the market is pricing at about 88 basis points of cuts. Yes, we're talking about the cuts next year because it's for the long end on rates. It really is going to come down to, do they confirm that? Okay, 3 or 4 cuts next year. What if they dial it back to 2? You know, like, and it's, but just to throw this in the mix as well, there's been massive shorting amongst the hedge fund community of rates to the point at which regulators are kind of taking notice. So a lot is hinging on what we learned today.
That's right. So you're absolutely right that there's not much suspense about what they're going to do at 2 o'clock. Takes all the fun out of covering the Fed. It's like covering the World Series when they tell you the score before the game, you know. So everybody is going to be looking at what they say going forward. Last time, there were a number of people seeing rate cuts at the middle of 2024. I'm not sure whether they're going to do that again. They have to be careful not to get the markets too giddy, because if the markets start to expect rate cuts then they may get more juice for the economy than they'd like to see. So it's a tough call for them, and a lot of it has to do with what their forecast is, both for inflation and economic growth.
No, you're right, and it's exactly what Jamie Cox told us at the beginning of this hour, where he said once they know that the rate hike cycle is over, you start to see yields decline, you start to see people pile. He said cash will no longer be king, people are going to pile back into stocks, you know, financial conditions ease.
One of the things that makes this interesting for us who've watched this for a while is there's always been this question about how long are the lags in monetary policy. And I'm sympathetic to the view that the lags are shorter now because they tell you so much, all this forward guidance, the bond market reacts very quickly. So they have to be careful about how they calibrate that when they put their SEP together and what the chairman says.
How much, we just put a little comment up there saying inflation is cooperating with the Fed. How much? Really? A lot or a little?
I think it's cooperating a lot in that it's coming down. That's what they want to see. And people seem to have looked at the last number, and if you thought inflation was coming down, you pointed to the half of the indicators that said it was, and if you didn't think it was coming down, you point to the other one. It was. It's kind of one of those mixed reports. So I think it's cooperating a lot in that all they want to see is it's coming down. What they don't want is unhappy surprises of it going up. Now, the big question is how quick.
People don't seem to feel it coming down.
Well, that's true, but that's a different question.
The Fed is trying to steer, but it's an important question.
It's particularly politically.
Yes.
Yes. Like, I don't think people are convinced that inflation is coming down. And also, people look at the level of prices.
For sure.
They don't recognize that if it's going up at a slower rate, that's victory. So what makes Jay Powell happy may not make Joe or Jill Sixpack happy. Yeah. And that's a big political problem. But from the Fed's point of view, if inflation continues to come down gradually, the pace of the labor market slows a little bit, they can afford to be patient. What they have to worry about is that doesn't happen. And there's this other wrinkle about oil prices. If oil prices are up, you know, headline inflation is going to go up. And the Fed wants to look through this, but they can't seem like they're not paying attention because, you know, I have to buy gas. I don't buy core.
Not to get super wonky about this, but
Kelly heavens, not to get super wonky.
If only we really focused on nominal GDP, that would help clear up a little bit of the confusion, right? Because the difference between the way that energy and food acts like a tax and maybe it's supply. The point being, nominal GDP was growing at almost 14% at the end of 2021. That 14% is an astronomical number. We're down to like 4%. So that just tells you how much potential we could really have for inflation and all the rest of it going forward.
So, you know, there are economists who advocate that the Fed should have a nominal GDP target. And I think the counter has been it may be hard to explain to people that
and to track.
And yes, because GDP gets revised and all that. But I think that part of this is what do you use to steer the economy? And you want to look at things like nominal GDP. And then how do you communicate with the people and the markets? And I think where the Fed has been successful in holding down inflation expectations is by suggesting they have a lot of resolve to keep inflation coming down. And in a sense, we're in an inflation targeting regime now. They don't talk about it that way, but that's what they're really doing.
Haven't we always been, or?
No, and, you know, when you and I started covering this stuff, people weren't so sophisticated about inflation expectations. There was a lot of M2, and well, maybe not when you started.
Right, no, the people who still want M2 to come back.
Yeah. Odds of a soft landing, high, low. What do you say?
I think they're high.
High.
Yeah.
It'll be one of the rare times.
It will, but look, I think things are breaking the right way. I'm not sure. I'm not confident. I wouldn't if I were the Fed, I wouldn't bet on it. But compared to where I was 6 or 9 months ago, I think it's much more likely.
David, thanks very much. Always great to see you.
Good to see you.
One of the treats of coming down here. David Wessel with Brookings.